BNP Paribas presents a compelling value proposition rooted in its fundamental strength as a diversified European banking franchise, currently trading at a significant discount to tangible book value, P/B ratio of approximately 0.55 as of November 2025. This discrepancy is not attributable to operational weakness. The firm achieved a 9M25 return on tangible equity (ROTE) of 11.4%, but rather to an idiosyncratic risk premium stemming from the ongoing Sudan litigation verdict. The core investment thesis hinges on the bank's ability to successfully execute its strategic plan, achieving a targeted ROTE of 13% by 2028. This achievement is underpinned by the profitable integration of AXA Investment Managers and continued strength in its corporate and institutional banking (CIB) division. Concurrently, the firm's capital base remains highly resilient, evidenced by a Common Equity Tier 1 (CET1) ratio of 12.5% as of Q3 2025, which supports continued active capital management, including the recent cancellation of shares following a Euro 1.084 billion buyback program completed in June 2025. The current valuation implies substantial doubt regarding the realization of these strategic targets or the ultimate cost of the legal uncertainty. B. Near-term catalysts and headwinds. If the legal risk is favorably resolved on appeal, the resultant normalization of the equity risk premium, estimated by some analysts to depress the anticipated 2028 valuation by 16 billion euros, is expected to trigger an immediate and substantial multiple re-rating toward or above 1.0x P/B, representing a significant return opportunity. Near-term operational catalysts include the realization of the initial 400 million euros in cost savings from the AXA IM integration, alongside organic risk-weighted asset (RWA) generation following the conclusion of the bank's regulatory model update cycle. Key headwinds include regulatory risks associated with the Sudan appeal, which has caused volatility and valuation uncertainty. Furthermore, there is potential lingering pressure on net interest income (NII) if the low interest rate environment persists, and increased operational expenses tied to the AXA IM integration temporarily dampening the group jaws effect. The current low P/B trading multiple is dominated by a specific, identifiable risk event, the Sudan litigation, that is overriding the fundamental earnings power (ROTE) 11.4%. The investment decision must therefore incorporate a positive assessment of the appeal process, as clearing this legal risk would immediately normalize the implied equity risk premium, generating significant alpha independent of typical banking cycles. I. Strategic positioning and business model resilience. A. The diversified integrated model, structural advantages. BNP Paribas operates a highly diversified and integrated business model, strategically organized into three primary operating divisions: corporate and institutional banking (CIB), commercial personal banking and services (CPBS), and investment and protection services (IPS). This robust structure provides structural advantages by allowing the bank to generate reliable revenues across differing economic cycles, contrasting favorably with highly specialized peers. For instance, the cyclical strength of CIB's capital markets activities, such as the global market segment, which grew 9.4% in 3Q25, can provide alpha during periods of market volatility, while the stable fee-based revenue from IPS provides structural resilience and dampens overall earnings volatility. B. The execution of the GTS 2025-2028 strategic plan. The group is currently executing its GTS 2025-2028 strategic plan, which is defined by three pillars: growth, technology, and sustainability. The strategy aims to consolidate European leadership while utilizing technology for operational efficiency and aiming to accelerate mobilization towards sustainable finance issues. The ultimate measure of success for this plan is the commitment to reaching a 13% ROTE target by 2028, supported by management expectations for compounded annual growth rates for revenues exceeding 5% and net income exceeding 7% over the 2024 to 2026 period. C. The AXA IM acquisition, a deeper analysis of the fee-based growth engine. A critical component of the growth pillar is the integration of AXA Investment Managers, IM, acquired for $5.1 billion in cash. This acquisition transforms BNP Paribas into one of Europe's largest asset managers, with assets under management surpassing 1.6 trillion euros. The strategic rationale is to shift the group's revenue mix toward higher-margin, low-capital-intensive fee income, which structurally improves the quality of group earnings and reduces RWA intensity. Management has set clear synergy targets totaling $550 million by 2029. These synergies are granularly defined. $400 million are expected from cost savings and $150 million from revenue gains. The explicit delineation of synergies into a larger, more controllable component, cost savings, and a smaller, more volatile component, revenue gains, helps mitigate execution risk, as cost reduction is typically easier to achieve than market-dependent revenue generation. The acquisition is projected to improve group ROTE by over 40 basis points. Furthermore, the acquired business itself demonstrates superior capital efficiency, with management raising the expected return on invested capital, ROIC, to 18% in 2028 and 2029. This high return profile confirms the strategic value of the deal in structurally elevating the overall quality and capital efficiency of the group's earnings base, which is essential for reaching the 13% ROTE target. 3. Financial performance and profitability analysis. A. Revenue dynamics and operating leverage. Group financial performance in the third quarter of 2025 demonstrated solid operational resilience. Group net banking income, NBI, reached €12,569 million, representing a 5.3% increase compared to Q3 2024. Net income attributable to equity holders rose 6.1% to $3.04 billion. Operational efficiency, measured by the Jaws effect, remained positive at plus 0.4 points for the group. However, the core operating divisions, when excluding the temporary drag of AXA IM consolidation expenses, generated a much stronger Jaws effect of 2.0 percentage points. This discrepancy demonstrates strong underlying cost discipline that is temporarily masked by integration expenses, confirming the cost control focus necessary to achieve the long-term efficiency goals. The overall cost-to-income ratio stood at 60.6% for the first 9 months of 2025. B. Divisional Performance Deep Dive, Q3 2025. The diversified business mix proved highly effective in Q3 2025. Corporate and Institutional Banking, CIB, reported a record quarter with NBI up 4.5% year-over-year. This performance was heavily skewed by global markets, which achieved strong growth of 9.4%, driven primarily by a surge of 17.9% in equity and prime services. Conversely, global banking revenues decreased by 2.6%, reflecting cautious corporate client behavior due to geopolitical uncertainties and tariff announcements. The reliance on the cyclical and volatile equity and prime services for a record CIB quarter introduces potential earnings volatility if market conditions deteriorate. However, this risk is substantially mitigated by the simultaneous and structural growth of the Investment and Protection Services, IPS division. IPS revenues grew significantly, up 27.5% in Q3 2025, driven by the consolidation of AXA IM. Organic growth remains robust. Wealth management revenues rose 10.4% with €4.2 billion in net inflows. Pre-tax income for the wealth side grew 25.7%. The substantial growth in stable, fee-based IPS revenue acts as a crucial structural stabilizer, dampening the overall earnings volatility and reinforcing the rationale for the strategic plan's focus on diversifying away from core lending risk. Commercial, Personal Banking and Services, CPBS, also showed a confirmed rebound, benefiting from positive movements in the interest rate environment. C. Profitability metrics and trajectory. In terms of profitability, the 9M25 ROTE reached 11.4%, keeping the bank on track for its full year 2025 target of 11.5% and forming the necessary base for the ambitious 2028 target of 13%. When comparing against major European peers, BNP's normalized return on equity of 10.23% places it at the top of the cohort, exceeding Deutsche Bank 10.19% and Société Générale 9.47%. IV. Capitalization, risk management, and regulatory framework. A. Capital adequacy and management strategy. BNP Paribas maintains a robust capital position well in excess of regulatory minimums. The Common Equity Tier 1 (CET1) ratio stood at 12.5% as of 30 September 2025, significantly above the required regulatory minimum, 10.42% as of March 2025. The bank demonstrated strong organic capital generation amounting to 30 basis points in Q3 25. Management has set a stable forward target of 12.5% CET1 by the end of 2027, factoring in the implementation of the fundamental review of the trading book. B. The impact of Basel IV, finalization of Basel III. The group has demonstrated proactive adherence to regulatory changes by already restating its 2024 quarterly series to reflect the transposition of Basel IV into European Union law. Furthermore, the bank has internally raised the allocation of normalized equity for RWA calculation from 11 to 12%. This increase in the internal equity hurdle rate signals management's absolute focus on RWA efficiency. This suggests future strategic growth will favor low RWA density businesses, such as IPS, over traditional RWA-heavy commercial lending, aligning capital deployment with the high-return divisions necessary to achieve the 13% ROTE target. The observation that the regulatory model update cycle is ending reinforces that future RWA changes must now be driven by profitable organic growth rather than regulatory adjustments. C. Asset quality and credit risk profile. The bank's asset quality remains exceptionally strong. The cost of risk, COR, stood at a contained 39 basis points of customer loans outstanding in 3Q25, keeping it well within the bank's guidance trajectory of below 40 basis points for the 2024 to 2026 period. The ratio of non-performing loans, NPLs, is low at 1.7% in 3Q25. Credit coverage is robust, with the Stage 3 coverage rate reported at 66.6%. The loan portfolio is conservative, with 79% of total credit exposures rated as investment grade. V. Macroeconomic and idiosyncratic risks. A. Interest rate environment sensitivity, net interest income, NII. Potential significant reductions in central bank interest rates remains a key macroeconomic uncertainty. While NII is starting to rebound, volatility persists. BNP's strategy to support the 2025 revenue target, plus 3%, is focused on managing the liability side, specifically achieving a significant increase in deposit margin due to the stability and high volume of non-remunerated deposits. The exposure in specific regional markets also illustrates the complexity, with the bank's Polish banking division estimating NII sensitivity at approximately PLN $180 million for every 100 basis point decline in interest rates. B. The Sudan litigation contingency, quantifying the legal risk premium. The Sudan litigation represents the most significant non-operating factor impacting BNP's valuation. Following a U.S. jury verdict in October 2025, the bank is facing liability related to banking services provided to Sudan's government that violated sanctions. BNP Paribas has vigorously disputed the ruling, stating the verdict is fundamentally flawed and confirming it will pursue an appeal. The market's initial reaction included a 10% share drop. The financial threat is amplified by the potential for contagion risk, given the existence of an estimated 20,000 Sudanese refugees in the U.S. who might seek damages. This possibility represents a massive, unquantifiable liability that has caused analysts to aggressively increase BNP's assumed cost of equity, COE, to 12.5%. This elevation of the required rate of return is estimated to have resulted in a $16 billion reduction in the bank's anticipated 2028 valuation. The deeply discounted PB trading multiple is thus directly linked to this risk-induced COE spike, demonstrating that the market is not penalizing BNP for operational failings, but for an uncertain future liability. The consequence is that success in the legal appeal by removing the contingent liability would act as a powerful immediate re-rating catalyst, releasing this trapped equity value. C. Valuation analysis and peer comparison. A. Relative valuation metrics. BNP trades at approximately 0.55 PB as of November 2025. This valuation implies substantial market doubt about the realizable value of the tangible book. The valuation gap is only justified if the market fundamentally disbelieves the bank's ability to meet its 13% ROTE target, or if the COE remains permanently elevated above the ROTE, driven solely by sustained litigation risk.
Capital allocation and shareholder returns. A. Share buybacks and EPS enhancement. The completion of the €1.084 billion share buyback program in June 2025 resulted in the cancellation of 14,025,914 shares at an average price of €77.29. This share cancellation immediately reduces the share count, boosting EPS and enhancing tangible book value per share, €91.2 as of 30.0925. This demonstrates a disciplined approach to capital deployment, leveraging the current undervaluation to enhance shareholder returns. B. Dividend policy. BNP maintains a long-standing dividend track record, paying a gross dividend of €4.79 per share in 2024. The commitment to predictable shareholder return is a crucial component of its valuation defense, providing yield support while the stock is trading at depressed levels. 8. Conclusion. A. Synthesis of findings. BNP Paribas is confirmed as a top-tier European bank with demonstrably strong operational momentum, 11.4% ROTE, and robust capital metrics, 12.5% CET1. The strategic plan to achieve 13% ROTE by 2028 is credible, driven by effective cost control and high-margin fee income growth from the AXA IM integration. The market's current valuation discount is a direct consequence of the unquantifiable Sudan litigation risk, which has inflated the perceived cost of equity and caused the stock to lag far behind operationally comparable peers. The stock is currently priced as if its ROTE will structurally decline or that a massive, unquantifiable legal liability is certain. The investment opportunity is defined by the high probability of fundamental earnings achievement combined with the potential for resolution of the idiosyncratic risk. If the legal appeal is successful, the resulting normalization of the cost of equity will precipitate a rapid and significant P/B multiple expansion, offering substantial returns relative to peers. The strategic gains from diversification and RWA efficiency are expected to compound the returns once the litigation overhang is resolved, providing an asymmetric risk-reward profile at the current deeply discounted valuation.